What I want to ask you, though, is you guys put out this latest report, Will It Last, is the title.
Yeah.
Will what last?
I think when we wrote that, we were trying to help our clients understand, is the growth environment, which has been quite strong, going to persist, and also will capital markets continue to be strong? So taking a step back, at Goldman Sachs Asset Management, one of our views going into the year is that we were going to be in a really synchronous growth environment, that we'd have all regions of the world pulling together, and that would be very good for risk assets. And that really has happened. If you look at, while there's obviously some challenging geopolitical headlines, if you look at underlying growth, it's been extremely robust, and it's been the broadest growth environment that we've had really in the last 5 years. And so in the back of that, with that context, we like equity over credit and credit over rates. So within equity markets, our preferred asset class, we still continue to be very positive. And the good news is that strong growth environment has really supported earnings. So actually this year, as an equity investor, I'm really interested in the fact that we've had the first year of double-digit earnings growth in global markets that we've had in the last 5 years. It's the first time in 5 years we've had double-digit earnings growth. So that's the good news. The challenging news, coming back to that headline, will it last, is that valuations are very demanding, particularly in our largest and most liquid
Is that how you're
market.
describing it? Very demanding?
Very demanding. Well, we can call it expensive, too.
There we go.
Particularly as it relates to U.S. large cap markets, because valuations are in their 99th percentile. And so it's really important for investors to look beyond the largest and most liquid markets to find reasonable valuations and good upside.
Where's that?
So we look in the U.S. market outside of the growth area. If you look at value, for example, in U.S. markets, there's actually still some good opportunities there. So value within the U.S. is trading at about a 30% discount to growth. That's the widest dispersion since the tech bubble in the early 2000s. So that's attractive to us, and we see opportunities there. I'd also say going down in market cap in the U.S. is pretty interesting. So if you look at U.S. small cap companies, they always traded a premium to large cap, but that premium has shrunk. And the other interesting thing about U.S. small cap companies is they have an effective tax rate of about 35%, whereas the larger cap companies in the U.S. have an effective tax rate of 26%. Why does that matter? Because they aren't pricing in U.S. small caps the possibility of tax reform. That was priced in at the end of last year when the markets rallied. It hasn't been priced in this year, and we think there's actually some possibility of getting tax reform.
Yeah, I was going to ask you about that, actually, because obviously expectations of major deliverables from Donald Trump drove valuations up, say, 17, 18 times this time last year to about 20, 21 times early this year. We've obviously not gotten any major deliverable, yet we're here at 2021 times. What's driving up valuations? You talked about earnings, but how high can we actually get both on large and small caps?
Yeah, so, I mean, what's driven valuations is the fact, I did say, I mean, earnings ultimately are driving equity markets. They've been very supportive. And then, of course, the part of the market that's performed best is tech. And there's been a lot of support for that story, and that's driven markets higher. But again, to your point, what hasn't actually rallied this year and what's actually sold off a lot is the part of the market that would benefit a lot from getting some part of this agenda through. I just think the markets are too pessimistic on the possibility of any reform out of Washington. And if you share that thesis from us, you'd want to be overweight value, and you'd want to be in this smaller cap part of the U.S. market. And then we have to admit, U.S. overall still is expensive, so of course investors have to look beyond the U.S. And in a developed market context, you know, one market that we would point people to is Japan. I just spent a couple of days there earlier this week. When in a world of full valuations, Japan stands out because it's at a 20% discount relative to the U.S. And as an equity investor, one thing I'm observing this year that I think is quite interesting is that we've had a rally in Japanese equity markets at the same time that we've actually had a strong yen. That's quite unusual in the historical context of the Japanese market. So it's telling us something, perhaps, that this rally in Japan could be more sustainable.